Hello, everybody. So I didn't want to wait until the earnings call to get the earnings presentation to report on HIMS's outstanding Q3. They did so well. Of course, you won't be surprised to hear that they've beat their own guidance for Q3. They had guided at the high range, 222 million in revenue. They did 226.7 million, and they ended up with their adjusted EBITDA in the high end of that range. Now, of course, as long as adjusted EBITDA is positive, I'm very happy. That's what I care about. I want the stocks to invest in growth. HIMS is the one company that is still investing in its growth and not trying to show GAAP profitability just to please the market. And you'll see this at the end of the video with a great announcement that they just gave 10 minutes ago. Let me tell you about the outlook for HIMS. This is the fourth time that they update their outlook upward. The fourth time. In Q4, they said this, then they updated it to this, and then they said this, and they updated it to this. And now, again, they've updated it. In Q2, they had said this. Not only did they beat it, but in Q3 for full year 2023, they are telling us they will do between 868 and 873 million. And almost 50 million in adjusted EBITDA, because I'm assuming, of course, when they report Q4, they will also handsomely beat these two metrics, these two numbers. So this is outstanding. This is a company where really that guidance, you may remember from Q4 of 2022, when they gave us this guidance that I've been using in my videos, that guidance now looks super, super silly. I mean, that looks super silly. Of course, they're going to do that in 2025. They're going to do much more than that in 2025. They are on track, in my view, to do 900 million or close to it, right? 895 million for 2023. They've got an 873 million for 2023. Do we really believe that this company in 2 years will only grow by 300 million? No. In my view, it will go by much more than that. And the same is true for adjusted EBITDA. They had guided 100 million of adjusted EBITDA. They've just guided us 46 million in 2023. 46 million in 2023. So adjusted EBITDA, usually when you get to that scale of a business, when a business is using its operating leverage, adjusted EBITDA is going to grow multiple times faster than the revenue growth. And this is a business whose revenue growth is not slowing down. It is well anchored in the high 50%. The long-term guidance needs to be updated, and they probably know it. And I'm thinking they will update it in Q4 of 2023. I'm thinking as well when they will update it. Now, I did not wait for the earnings presentation to make this slide, so I just reused the one from Q2. We are in Q3 now. I just reused their slide from Q2. So in Q2 they had 1.3 million, 1,300,000 customers. So 1.3 million customers in Q2. In Q3, they have 1.4 million customers in Q3. In other words, said differently, the law of large numbers is barely making a dent into HIMS's growth. Barely. Because they added 100,000 customers in Q3 versus 91,000 customers in Q2. So in absolute terms, the growth is accelerating. Right? We would expect a little slowdown, but no, there's no slowdown. It is slightly accelerated. I'm thinking they will hit the law of large number at some point, but this is a company that has so much growth ahead of it. Where is the competition? Where is Roman? Where is Keeps? Where is all of these other companies? Where is Amazon? Right? All of the narrative we've been hearing for 3 months. Where is all of this? Where is the recession? There is no recession for a stock that sells recession-resistant products. Like people are going to keep getting care, especially when the care that you're getting is so inexpensive compared to what you pay for insurance, compared to what you pay for the copays. Now, I have to warn you, I can predict to you what the narrative is going to be with the bears. What are the bears going to say? They're going to do this little calculation that I just did. They're going to look, they spent 116 million in marketing this quarter, right? In Q3, they spent 116 million in marketing. They got 100,000 new subscribers. The cost per new subscribers is $862. Now that's peanuts compared to the lifetime value of a customer. Keep in mind, they have plenty of customers that have been receiving treatment from HIMSS for 6 years now. Right? Yemi said that on the call 2 calls ago. We know these customers stay a long time with the company. We know the retention rate is 85% after 2 years, right? And they spend 116 million, so that's 862. And the bears are going to say, oh, it increased because last quarter it was $850 if you do the same calculation. It's flat, okay? It is flat. It is up a little bit, down a little bit. This is within the margin of error. The cost to acquire a customer is not showing some incredible rise in cost. It is roughly flat. I have no issue imagining this cost going to 850 or 840 in Q4, and people will say, "Oh, it's awful. It's going down or it's going up." Doesn't really matter, right? It's cheap, in my view, compared to the lifetime value of a customer. When someone starts getting preventative healthcare from HIMSS and they start tasting this in their late 20s, early 30s, they are a customer that's going to stay well over 10 years. In my view, it's the 10-year out thing. Now, of course, in financial models, right, your discounted cash flow, you never look at more than 10 years out. But if you're a long-term investor, if you care about the future, you clearly look at 10 years out. This is a company that even when growth stalls is going to have tremendous inertia. Right, tremendous inertia. That's the point of these subscriptions, right? You still have people that have landlines and that pay their landlines to AT&T, even though the cell phone has been around for 20 years. These businesses create a lot of inertia on which they can then exploit their competitive advantage and they can then get margin. You don't lose customers overnight. I'm very happy they're investing in marketing. Kudos to the CEO, kudos to Andrew Dudum to keep investing in marketing to build that customer base, which then allows them to do better prescription and a better job. And if you saw the announcement this morning, right, we're all happy to see this on Twitter this morning. They announced MedMatch, and if you watch this full video, there's a few key points, but you can see that they can offer better care because of their proprietary data from their million-plus customers, because they can use that data, and they cited the absence of complexity. They cited that much of the healthcare experience is dedicated towards billing and reimbursement right now. And they cited because they removed that complexity, they're able to achieve better outcomes both for the patients and better outcomes both for the providers. These providers who have to give these prescriptions, who actually in the real world spend much more time worrying about reimbursement, worrying about insurance, rather than they spend caring about actually providing the right care. And I think this is an early step into AI, and simply having AI prescribe when the laws evolve, and the laws evolve that will evolve at some point, having AI prescribe the best medication for you. I don't have a full presentation, so I can't tell you all of the new products, so I'm going to make a new video with a full presentation. When they release it, they typically release it a few minutes before the call. The call is in 12 minutes as I record this video. The last piece of good news as I record this video is the 50 million share repurchase program, the share buyback that they've announced. So HIMSS thinks its stock it's really cheap. And so the dilution is going to go the other way if they start buying back shares. And I'm very excited about this. I usually prefer to see my companies invest in marketing. I'm usually pretty wary of buybacks. But when a stock is growing as fast as it can, which is clearly the case for HIMSS, revenue accelerating and growing well into the 50%. That's clearly the case for them. Then in that case, I'm okay with buyback, and I think it's great. They're doing something that a company much more mature would do, and they're already doing it now. And that is the fair thing to do because this stock is way too cheap. It should not be this cheap in my view. The market is having this very intelligent reasoning of SPAC bad, small cap bad, rates up, and that's why it sells of these stocks. So whatever happens to the stock price, and I haven't really looked what the stock price is doing, in my mind, this is an amazing quarter. The growth is accelerating. The new subscribers are accelerating. 100,000 new subscribers in Q3 versus 91,000. It is accelerating. I am so pleased. Oh, last thing I didn't comment, the gross margin. The gross margin is up by a few digits. So I'll report more into this into my next video. I'm obviously going to listen to the call, like most of us, I believe. Thank you so much for watching. This is not investment advice, just entertainment, and it's great entertainment today, but not investment advice. Appreciate your likes, appreciate your subscribes. Thanks for watching, and have a wonderful day.